So Himanshu has accepted our invitation to talk. Yeah, the recording is running. Himanshu was written up in the book Mark Options Wizards as King of Calendars, I believe. And he has also had a tremendous track record over the years. Did you actually do market making at one point, Himanshu?
No, I have never been in any Wall Street firm ever.
But that has not in any way, well, that makes him that much valuable to us as someone with our own background to a certain extent. I know you worked with Dan Sheridan at one point.
Yes.
Mm-hmm. And, you know, one of the things that struck me that made me want to hear from Himanshu a lot is his some of his recent talks in which he says now that he's found directional trading to be a tremendous enhancement to the calendar spread trading and other spread trading that he previously did and still does, of course. He's been an extremely active trader, I have the impression. He shows his account every week in Trading Group 7, and I have a feeling it's been a tremendous success all the way from the beginning. Now, many of us have here in this group, and we have people from Himanshu's group as well, but many people in our own group have long traded delta neutral credit spreads. So I'd be very interested in hearing from Himanshu, you know, how his own trading has evolved from calendar spreads and neutral credit spreads to now taking perhaps a stronger directional bias than he did before. And I believe he's encapsulated certain directional techniques, technical analysis techniques that he finds useful. And just by way of introduction, I'm sure he may introduce himself, but he runs Trading Group 7 on Aeromir, which is free. Every week you can join it for, I guess, a 1-hour webinar. And that is an excellent running introduction for many, many, many years on his own trading approaches. And we certainly recommend that to people. He also has a class that you can join or subscribe to on Aeromir. And he's got a book coming out soon that we'll also look out for. He also does tutoring or mentoring. And with that, I will hand it over to Himanshu.
Okay, thank you very much for that introduction. Well, to answer one of the questions that you asked, in the beginning, yes, I was doing what we call delta neutral trading. This was before the weeklies had come out, but just look at this chart of SPY. From 1st January, it was around 378.9, and by 1st February, it was at 411. This is the SPY, not the SPX, okay? If you were delta neutral, you are in some serious pain right now, if you are still in the trade. Now, remember in 2006, 2005, for the E-mini S&P or the SPX to make a 53-point move was unthinkable. Anybody remember those days? I remember the first time that SPY actually made a 3-point down move, people were literally like screaming in pain. Then the second time on 28th of February 2007, the SPX dropped by 1,058 points by 10:15 in the morning. And that was the first time that we heard the term fat finger mistake, which is very strange, right? I mean, such a mistake had never happened before, and all of a sudden the market goes down by 1,058 points. And then by the end of the day, the market was down by only about 570 points. But still, that was the biggest move that I had experienced since 2002. Then, of course, we had 2008, we had the real estate crisis, and then a couple of minor stuff in 2012. And then, as we saw in 2020, the market literally went berserk on the upside. See, this is 2020, when the coronavirus hit, it dropped like a rock, and then it just kept on going up for the rest of the year and the next year. Now, if you are doing delta neutral trading here, you are, I don't know, you are a praying man, I guess, or woman. Let me be very fair here. In other words, depending on the market, it is advisable to either be directional or be delta neutral. Did that answer your question?
Absolutely. Absolutely.
So that essentially is why I switched over to pure technical analysis, which tells me which way the market potentially is going to move, and then place a directional trade. Doesn't matter what it is. It could be a calendar, a diagonal, a butterfly, half an iron condor, or a condor. I'm sure most of you know the difference between a condor and an iron condor. And since I started doing that, my results have actually gone through the roof. I mean, literally, where previously, you know, if you make in a calendar, if you make 10%, and at the money calendar, if you have a directional calendar, you are now suddenly making 40% on the same trade. And even better, a directional calendar will be cheaper than a calendar that is at the money right now. For example, right now, the current price is at 442, right? So if I were to place, then this is SPY. If I were to place a trade in SPY at 442, exactly at 442, and this is my normal calendar where my front is about 36 days and my back could be anywhere between, say, all the way here in September, 2 months further away. This is going to cost me $6.97. And this is a call calendar. Now watch this, okay? If I go with a put calendar, it's going to cost me only $4. So this is just the difference between calls and puts. But if I believe that SPX is going to go to some previous level of resistance, say 449 or 450 or 455, and I were to place a trade at 455, it's only going to cost me $1.97, which is a significant difference between 440. This is like less than half. Again, this is a put. The calls were at 697. If we go with calls, we're still spending $4.93. But that's still almost close to $2 less that I'm spending.
Isn't there supposed to be something called put call parity?
Well, there are a lot of things out there. What I have found is that it's like your car's dashboard. There are at least 20 different things that you can look at your car's dashboard, right? While you are driving. But while you are driving, essentially you are looking at just one or two things. What your speed is and whether you have enough gas to get where you want to go. The rest of the things essentially are just there, but you never look at them. Once in a while, maybe you do, but most of the times, how many of you look at every gauge or every button on your car's dashboard? like literally every 2-3 minutes.
Sure. Could you maybe, we have, I think, 19 people here who have never been to a meeting before. So could you maybe explain, I know this is incredibly simple-minded, but could you maybe explain that calendar, what a calendar is? You sell the near leg and you buy the far leg, is that right?
Yep, that's about it. And they both need to be at the same strike. Otherwise, it's a diagonal, not a calendar. And I mean, for those of, you can then analyze this trade, which will give you a general idea of what, see, this is an out of the money calendar. So if SPY keeps on moving up, I keep on making a lot of money. In this case, I'm spending $493. And I can make, well, it says 94, but really by 722, I can make $447. Of course, I'm not going to wait until I get there. The other thing is that a lot of people are like, oh, things are moving in my direction, so I'm just going to, go party. A lot of us don't have a plan of action. We don't just say, it's like saying, I want to go from New York to California, so I'm just going to get into my car and start driving. And then I finally realized that I'm running out of gas. And then I hit a gas station, which is when I realized that I have forgotten my wallet. Now, I don't know if any of you have been in such a situation, but it is not a good place to be. Ron is asking, when do you exit? I already said, when do you exit? You exit when you have made your 10%. Or 15 or 20. You decide where you want to, how much you are going to risk and how much you are going to make. Remember, this is not what we call investment strategy. If I believe that Tesla is going to go through the roof, I will buy Tesla and then hold on to it. And it could be, I could be holding on to it for a year or 2 years or 5 years or 20 years. But if I buy Tesla at 100 and I buy 10,000 shares, if it goes to 95 or maybe 92, I may say, you know what, I don't want to risk anymore. And of course, there will be other parts of me that will say, oh, but it's Tesla, it's never going to go down to 50. And I might be right, but what if I'm wrong? Plus, while this trade is going on, I am losing money, or I have already lost a little bit of money. And we tend to think that, well, unless I get out, this loss is not real. Because Tesla is definitely going to come back, right? I mean, it's Tesla. Why should it even go down? But obviously, if you bought Tesla at 414, and if you had the wherewithal to hold on to it until it came down to 98, but I bet you this is when the majority of the people, literally right here, the majority of the people were selling. And when more and more people were selling, that is the place where the big boys had started buying. Make sense?
Sure. So
Bruce
this
has a question here. Profit is
Okay.
10% of margin. Remember, in a calendar, there is no margin. It's just the cost. So whatever your cost is, if you make 10% of that, you are done. When you are using or putting on credit spreads, that is when margin comes into the picture. Because you are not really buying anything. You are selling a credit spread for a certain amount of cash, and they will hold some cash, which is known as margin. They will sort of lock it up just in case things don't work out for you. They don't care whether things work out for you or not. They want to make sure that things work out for them. Sorry, Don, you were saying something.
No, that's excellent. Well, I mean, I guess maybe we should just explore, because it's a fairly important theme, the notion that directional trading is the way to go. Would you agree that a lot of people have given up on directional trading, and a lot of people tried it and then they switched to non-directional trading, particularly all the credit spread community seems to have that philosophy. So that makes me wonder, like, does it take special skills for you to succeed using directional trading, or do you believe that anyone can
No,
do
I
so?
believe it's actually easier to succeed at directional trading because the market usually is directional. It never just stays in one place all the time, especially now. Remember in 2004, 2005, 2006, when we were all with Sheridan, if the mini S&P or SPX moves by 10 points, we would all be like, what the hell is going on? Today, if it moves only by 10 points, it's like, something's wrong. It should move more than this.
So
So
the,
in
the
other
character,
words, the personality of the market has changed, and therefore we need to change with it.
so you believe this would not have worked as well back in the old days?
Oh, it would have, it definitely would have, but it would have taken significantly longer. Yes, the market was always more like this in those days. But every now and then, some of the stocks or the ETFs would make a big move. Like, for example, when when the Gulf War began, oil went through the roof. But prior to that, for oil to move even $1 up and down over a period of 1 week was unheard of.
So I guess in the past, stocks had or at least indexes had the reputation of being a trading range market, as you're saying, or
Correct.
a
Yes.
market you would fade. And that is no longer the best way to trade them, is what you're saying.
Correct, because it's like driving in a old beaten up Toyota, and then suddenly you find yourself that you are at the NASCAR rally.
Yeah,
And since I'm from North Carolina, I know all about NASCAR.
that's great. Yeah. Did you go to school here, or?
Yeah, I was at UNC Chapel Hill.
Oh, wow, that's great. So does it require greater risk? What is the relative risk exposure, would you say, between the two different styles?
Well, I just showed it to you. If you buy an at the money calendar, it's going to cost you $600. If you buy an out of the money calendar, it's going to cost you only $4. By default, it's less risk.
And have you found that in your own trading that, I mean,
Oh, yes, definitely. Oh, here's another question from Natalie. She's is that when you buy with margin, I wonder if you can stay in as long as you move up the stop loss. Well, again, the way I trade, there is no margin. There is only the cost. So 10% of the cost is my first exit. So if I have 3 contracts at 10%, I am out of one, maybe at 12, 13%, I am out at another. And then I will let the last one ride while having a stop loss in place. Wolfpack, indeed. And Mike has a question too. He says, I would like to know your approach for setting direction and what is the duration of your calendars. Setting direction is really, really very simple. You see this nice blue line on the screen? If prices are above it, I am bullish. If prices are below it, I'm bearish. And since I'm a nice dude, I'll tell you what this line is. It's a moving average of 21 days. But if you prefer 30, it'll still work. If
Is
you're a
it just a
short-term trader,
straight?
go with 10.
Yeah. Would you prefer a straight, would it be a straight moving average or an exponential moving average?
Irrelevant. Doesn't matter.
Really?
Yeah. They are all the same, essentially. Seriously, they are all the same. It's like, it's what's the difference between a Corolla and a Camry? One is more expensive than the other, right? That's about it.
There are a couple of good questions there, I see.
Yeah, I was looking at that. Frederick has a question. What quantitative studies have shown that the index SPA, example SPX directional trading is better than delta neutral trading? I don't know about any quantitative studies, but I am merely going by my own results. Because, even though it may be a quantitative study, different quantitative analysts who are essentially statisticians will use different methods to analyze. Have you ever met or been with 3 or 4 statisticians in a closed room? They will rarely agree on anything. And that is essentially the same thing with quantitative studies. Mike is saying, what is the duration of your typical calendar? The typical calendar, I start around 40 days from expiration. And sometimes I make my 10% in like 4 or 5 days. Sometimes when the market is ranging like this, it goes up, it goes down, it goes up, it goes down, then essentially I'm depending on theta, and it may take 15, 20 days. And my long-term calendars are a different thing. For example, just for those of you who don't know, let's suppose I believe that Tesla is a great company and it could go to 500. Right now it's at 255. It could go to 500 by the end of next year. So by the end of 2024, it could go to 500. And if I believe this, then what I may do is that even though it's at 355, I may actually start by putting on a calendar at 280. And if it touches 280 and goes beyond, I may add another calendar at say 320. And if it touches 320 and goes beyond, I may add another calendar at 340 or 350. All the while I'm rolling my the short part of all my calendars forward and collecting some cash. Did that make sense? So John has a question to how is this approach similar, different to looking to prices versus RSI? No difference whatsoever. RSI is an indicator and it is based on price. If you don't, for example, if you are looking at RSI of the last 14 days, you need to know the closing price of the last 14 days. And look, I'm looking at the closing price of the last 14 days. Guess where RSI is right now? It is above 85. In fact, let's put it on. RSI is the relative strength index, right? Okay, hold on. This is quick study. Hold on, there were lower studies, yes. RSI. Look, it is at 84.88. And I did not even need to have it here to know where RSI would be. Did that make sense, John?
So what would be your attitude to having the RSI out of the range like that?
Well, generally, the way RSI is being taught is that if it goes above 70 and then starts coming back down below 70, that means prices will sort of start moving back down. And then when it goes below 30 or 25 and then goes back up, that is the time to buy. In fact, in the old days, this is where you would buy right here you would buy, and right here you would get out. That was the trade.
But you would change that?
No, it still works. Had you actually gone long here and got the hell out of here, then yeah, you would have missed out on some of these profits, but don't worry about what you missed out on. Did you make a profit on the trade? And if you did, it was a great trade. Now, on the other hand, look, it went above and came down here. And so you would say, okay, I need to go short here. If you go short here, the next day you are screwed, at least a little bit. The day after that is the signal for you to get out of this trade. But a lot of us won't get out of this trade because we will say, oh, it is already above 70. The value of RSI is already above 70. So it's got to come back down, right? Because every time it goes to 70, it comes down. But yes, and it did come down, but it took what? If you bought something at 187.12, you had to wait all the way until March 2nd. So literally from February 2nd to March 2nd, you were sort of, biting your nails. So, well, sorry, here.
So, Himanshu, this is Mark Mosley here.
Hey, Mark, what up?
How are you doing?
Okay.
I love your Group 7 meetings on Tuesday afternoons. That's a great time. And I really appreciate you doing that for the trading community. I just thought I'd ask, so on this RSI we're looking at here, you can see how the line came up and put a little, it began to turn back down. Maybe that would have been your exit signal for a trade.
Well, yes, I agree. That would be the exit signal.
And the other thing I was going to mention, I use the advanced decline in my analysis, and I feel it's a sort of a momentum strength indicator. So I don't know if do you ever look at the advanced decline?
No.
No.
I have looked at every indicator and sort of studied it, but ultimately I realized that if I look at 50 different things, at the end of looking at these 50 things, I am still not sure which way to go, whether I'm bullish or bearish, whether I should buy calls or puts, or whether I should go with, iron condor or a broken wing butterfly, or, any of those things.
Sure.
And when I sort of, this is exactly what I said earlier, when I said that even though there are at least 20 different things on my in front of me when I'm driving, I'm looking at only 2 or 3. And even then, I'm not looking at them continuously. So here also, I'm looking at maybe 1 or 2. And again, not continuously. Once in a while, yes, like you just did, I will put this RSI down here and say, okay, is this going to go back up? But those of you who actually come to Trading Group 7, you know that I have my zones here, see? And once it reached this zone, I was ready to buy once it cleared the zone to the upside. And, this is also no big secret. If you come to Trading Group 7, then you know exactly how these zones are formed.
Are they based on long-term action?
No, these are just based on support and resistance.
I see.
Oh, here's another question. Why do you think your options approach with TA is profitable while typical strategy of simply buying and selling the underlying using TA signals are not profitable? I don't recall ever saying that simply buying and selling the underlying using TA signals are not profitable ever. If I had to buy Tesla, then yeah, I would have bought it right over here as a stock. Forget the option. If I desired to buy Tesla stock, that's where I would have bought it. Alan says 90% of all indicators are calculated from price are lagging. Yes, they are, depending on the parameter. RSI is lagging by 14 bars, whether they be daily bars or 5-minute bars, depending on what chart you are looking at. Oh, sorry, Adrian, I missed yours. Once you decided the SPY will go up, do you use calls or puts for the calendars? What is the days DTE of the long leg? That is a good question. Again, as I just showed you, puts are significantly less expensive, sometimes almost by 30%. So generally, I prefer puts, especially if I am trading a stock or an ETF. Because if I'm using puts, if I'm short a put, and if I'm in the money, then the stock or the ETF will be assigned to me, right? So I would prefer that I own 100 shares of SPY as opposed to being short 100 shares of SPY, because then not only if SPY goes up, not only am I losing money, but my margin goes through the roof as well, because I'm short like 100, 200, or 1,000 shares of SPY. Did that make sense? Therefore, in SPX or the RUT or NDX, I don't mind using calls because there is no assignment. And to continue with the second question, my days to expiration of the long leg could be anywhere. If my short leg is say 40 days out, my long leg could be 75 days, 80 days, 90 days. If I'm really, I actually like to trade no more than 3-4 underlying instruments. So yeah, in SPY, I may literally buy something. This is what we are in June. I may buy something end of July. And then, sorry, I may sell something end of July and buy something that expires in January. And
Himanshu, it's Mark again. We kind of alluded to something a minute ago, and I wanted to clarify. So when you sell a calendar, say above the money, would you ever do that in the puts to where you are selling a short leg that is in the money? Like say okay, for example, in Tesla, it's trading at about 255 right now, and we think it's going up. So we want to sell a calendar at 280, and you could do that in the calls or the puts.
Correct. But I would use puts.
You would use puts, even though the leg you're selling is in the money.
Correct.
Okay. I guess there seems to be sometimes a price advantage there, or the calendars.
Yes, I agree. Significant price advantage with puts most of the times. But again, see, it doesn't matter. You can go with calls too. If you are literally looking at your positions all the time, then now a lot of people are under the assumption that you will get assigned only in the last 1 or 2 days before expiration. I don't know where they got it from, but you could actually get assigned. If you are in the money in a put or a call, you could get assigned 3 months away from expiration as well. It doesn't happen too often, not in very, very like stocks like Tesla or ETFs like SPY and IWM. But if you are trading a very low volume stock, you could get assigned long before expiration is even around the corner. So, and I learned that the hard way, which is when I realized that, for stocks and ETFs, I would rather go with puts, with indices, go with calls. Or as Sheridan used to teach us, if you are going with a double calendar, have calls above and puts below. That is also a reasonable way to do things. The point is that it doesn't matter what you do as long as you know what the hell you are doing and you know when to adjust or when to get out. Essentially, that is much more important than learning about calendars and any other things.
So just to recap that for people, for indexes, they cannot be assigned.
Correct.
So, therefore, it's okay to use calls. But for
Yeah, because you will never be assigned, correct.
yeah, but for stocks, they could be, and so you better use puts for safety's sake.
Correct. I mean,
Okay.
if you are okay with holding 1,000 shares short of Tesla, then go for it. Go with calls. But I personally am, I actually don't even like stocks, to be very honest, meaning owning or having short stock is something that just bugs me the wrong way. I have no idea why. I seem to be okay with ETFs. I've been assigned 3,000 shares of SPY, and I'm like, oh shit. But such is life. Okay, Lindsay has a question as well. The SPX is stretched pretty far above the daily 21 EMA. Your thoughts on positioning a new SPX calendar? Hold on, the 21. What was that other style that I was at? I've forgotten completely. 21 EMA. Okay, fine. Let's just add it here. Well, again, it depends. The majority of the market works, what they call the reversion to the mean, right? If it is too far away from a moving average, it is going to come back to that moving average. And sometimes it is not too far away from the moving average, but it still comes back to the moving average. But right now, yeah, you are right. We have like a significant gap between, in fact, I remember one of my students a long time ago actually did a statistical study on the price and the value of the moving average and the difference between the two. And when that difference exceeds a certain amount, it is essentially a sign that prices are about to turn back down towards the moving average. But again, it was a quantitative analysis, and so I don't trust it. I trust my eyes a whole lot better. I myself have a minor in statistics, and I know exactly what statistics can do to you. It can really screw you up. Ron has a question. Isn't the key to watch the extrinsic value of the short put leg? The key is to watch the extrinsic value of any short leg, whether it's a put or a call. But that is not the only key. There are multiple keys. And as I said before, if you believe that, then you should have a call calendar above and a put calendar below, because then your beliefs will, how shall I say, will, jive with your own personal reality. But to be very honest, it really doesn't matter. I don't watch the extrinsic value of the short put leg or the call leg at all. I am just looking at where my calendar is based on the graph over here. Does that make sense? So I want my calendar to be somewhere in the middle 1/3 of the tent. And if it is not, then I will do something to ensure that it is. That's it. John has a question. Does the return? Yes, indeed it does. Instead of $6.81, if you go only with 451, 10% of $4.51 is a whole lot less than of $6.81. Correct. But that's why we are looking at 10%. That's it. End of story. So again, it doesn't matter. I mean, you can just buy, you could have just bought a call in Tesla when it was at 174. And then you can say, you know what, by now, obviously that call has made you 2, 3, 4, 5, 6 times your money. But the problem is not how much, whether it is 10% or 5% or 20% or 100%, that is not the real problem. The problem is, do you know when you are going to get out of a trade? If you say 100% and you are only buying calls and puts, then at 100%, do you get out? Because here you made a whole lot more. If you had an out of the money call calendar here, you made a whole lot more than 100%. But would you have gotten out at 100, or would you have said, oh my God, maybe I'll make 500%? So this has got nothing to do with the market. It's about you. This is all about you, the trader. Lindsay says SPX. That's nice. Oh, yes, I already answered that. It is stretched pretty far above. It is at a previous level of resistance here as well. So anything could happen, yes. So I would be more, if I am significantly bullish, I would reduce my deltas by a little bit right now. Yes, I agree. And George has a question. So what do you do when the trade goes against you? Again, it depends. If you are trading, if your plan says my trade has just gone against me, I'm down 10% and therefore I should get out, you get out. If your plan says, okay, I am here and my plan actually says that once I reach this spot, or when SPX goes here, I should add another calendar up above, then I will go ahead and add another calendar up above. George, you should know this. You are there every Tuesday. So it again, it depends. Sometimes if it is just a call or a put, there is nothing else you can do. Just get the hell out. If it is a long-term calendar, a calendar which is going to last for the next, 3, 4, 5, 6 months, then I will adjust and ride it out. Well, okay, yeah, not Tesla. Even with the other thing, the SPX is stretched out significantly higher, and it just hit one of our zones right here. But again, you never know. It could go to some other zone up here if there's one. Yep, there's another zone all the way up here. So it could go all the way to 4,600. That's almost close to another 175 points. But if you are looking at RSI, then, by tomorrow or the day after, chances are that, this is the weekly chart. So by next week, RSI might be above 70, which means you still would have to be a little bit careful. Ron has a question. Is the Tuesday group an open forum? Yes, it is. Sandeep is asking, could you walk us through an adjustment? Okay. Well, let's look at Tesla because that's what we were looking at earlier. Let's say I decide to buy Tesla today. It's at 255, right? I am still bullish in Tesla. So I will say, okay, it could go to this previous high, which is 294, but I might also say that, oh, this shit is too far away. Maybe I'll just go to 280, right? So suppose I start out, my calendar is at 280. Mike is saying, got to run, great job. Oh, sure. See you later. Where was I? So let's say we have Tesla and I have a calendar at, what did we say? 300. Let's just say 280. So I'm selling the 21st July and I'm buying, let's say 20th October, right? I'm spending $1,400. It looks like this. So if prices currently, where is the price? 255. So price is somewhere over here. If Tesla moves up, I make money. If it moves up even more, I make even more money. If it continues to move up, now I start losing money. So somewhere over here, I will say, okay, I need to then make an adjustment, right? So I will say, okay, where is my break even? My break even is somewhere over here. It's at 332. Or I can just look at the break even, the expiration level break even, and that is at 340. So if prices come to say 300, I will probably add a 330 calendar in Tesla, which is probably going to cost me something around the same. No, this is at the money that we are doing, so it'll cost me a whole lot less. But now I will have a double calendar and the current price will be right in the center of the tent. Does that make sense? Ron has a question. Could you please provide a link for the Tuesday group? The Tuesday group, we have it at aeromir.com. So you can go there and register for free. And you can sign up for Trading Group 7. Sandeep says that makes sense. Okay. Now here, of course, this today is 6:15, right? So this was, when was our expiration? 21st July. Or is it here that I'm supposed to do that? Yeah. What did I do? I think this is supposed to be July. And this is today. Yeah. Don Brady, oh, Aerometer. Okay, there you go. That's the link, Ron. So, any other questions?
I guess one thing that we might have in mind, Aeromir, is whether what would be a recommendation for someone who wants to get into options trading and do it right, and is a very elementary person, is just into getting into options.
Again, since I'm a directional trader, the first thing to learn is to figure out which direction the market is potentially going to move. So just to give you a very simple example, if you are just starting out in options trading, then I would, let's say you want to trade SPY or Google or whatever. Let's just stick to SPY. And I would also recommend that if you are starting out, you don't look at daily charts at all. Start with weeklies, because you will have ample time to get out of a trade. So if you are starting, and of course, I'm assuming that you know some basics of technical analysis like support and resistance, figuring out whether it's an uptrend or a downtrend. But if you don't, then essentially if prices are above the blue line, it's an uptrend. If it is below, it's a downtrend. That's it.
Would a person be able to, like you have a lot of, or a number of particular indicators or other indications that you use in trading for technical analysis. How much would a person, like, let's say that gives you a large, high expectation of a profit or good profits. How about somebody who just did, I guess you said moving averages, traded simply on the basis of moving averages? What fraction would they get of the profits that you get?
Again, not much. Because remember, as I said earlier, every single indicator is based on price. RSI literally is moving up from this point all the way up here because prices moved up all the way from here to here. So if you actually understand price action, you do not need any indicator at all. Do you remember the old days of Wall Street when they used to have that ticker tape?
Sure.
And it would literally update like every 5 minutes or something like that. But that is that is what somebody in the pits, they were the walls inside Wall Street, inside the building itself, they used to have pits. In those pits, all they had was these ticker tapes. So if you see spider moving from 442.6 to 442.8 to 443 to 443.2, guess what? On a very short-term time frame, it's an uptrend. And a dude in the pits will buy 1,000 shares of SPY, and when it goes from 443.10 to 443.20, he will bail out. He's a short-term trader. He's literally going by those ticks that he sees on the screen, which is exactly what I would do today if I were to look at a 5-minute chart of SPY. In fact, I was with a student, and around here, I bought a short-term call. And I bought it at about $1.80 and got out at $3.60. In fact, let me see, is it here? Or was it the other account? Here, there was something else I got assigned. So yeah, maybe it was the other. But yeah, it doesn't matter. I mean, if you want to see this live, I would have no problems meeting at 9:30 tomorrow morning. And I can show you. Remember, trading really is not that difficult. It is just all the mind-boggling amount of useless information that floats in front of you. Trading, what you are trying to do is finding a particular piece of information about something, let's say on Twitter, and trying to find that one particular piece of information about some topic on Twitter is going to take a long time, as opposed to going to, say, a news website or just google.com and say, I want to know something about ABC. Even though Twitter is supposedly faster, it's right there at your fingertips. But more often than not, things go south. I used Twitter once in my life because my daughter was like, you are not on Twitter? Get on Twitter. So I got on Twitter, and then an hour later, I got out of it. Because I'm like, and she's like, why did you do that? And I'm like, honey, if I need something from you, I'll pick up the phone and call you. I don't need to tweet you anything. So she says, yeah, but if other people are following you, then you can tweet them, about something that happened or something that didn't happen, whatever the case may be. And I'm like, why would anybody else want to know what happened or what didn't happen in my life? I mean, I don't know. I don't want to know what happened in your life this month.
So now you also have a course, a video course, which I posted the link to.
No, I don't have. I am actually building a video course right now. So far, what I'm doing is literally live training. Because, in video course, you can learn something, but if you have a question, then what happens?
So what about the link I just posted? What is that for?
This is just a trading group where we meet every Tuesday to trade a couple of these simulated accounts, just so that people can get a feel of what I do and whether they actually like it or not.
Yeah, but I posted another link.
So that group is like a public group. Anybody can join, and and some people will say, "Hey, can you put on a trade in Microsoft?" So we put on a trade in Microsoft. Somebody will say, "How about doing a broken wing butterfly in SPX?" And so we do that.
So you'd say people should just join, people should just join your trading group and get it for free rather than buy.
Yeah, they can go there too. That is where I am every Tuesday. But there, we are just trading. I mean, most people who are there, they have been around for a long time, and somebody will say, "Oh, this, according to this indicator, it looks like Tesla could drop like a rock." So I will say, let's put on a bearish trade in Tesla and see if it works. And we'll put on a bearish trade, and it may work or it may not work. But if it doesn't work, what do we do to adjust the trade, right? So that's what then we would also do. So Adrian is, so to summarize the technical side of this trade, use 21 SMA for direction, use SR for placement. Anything else? And try not to panic if it doesn't work out. And there will be times when it won't, because that is just the nature of things.
What is SR?
Support,
Support
and
resistance, support resistance.
correct. Support and resistance. See, there'll be times when you will be like, "Oh, I'm going to go short," and you go short, and 2 days later you are like, "Oh shit, I have to get out of my short and go long." If you are following the system, then you need to go long, literally. So you go long, and then 2 days later, you are like, "Oh my God, this is not working out." Now you lost again. So you go short, you lost again. Now you go long, nothing happens. And you right around here, you will be like, "Oh, I think this is about to go down, so I'm going to get out right now." And as soon as you get out, it starts moving up. Trust me, this will happen to you more times than you know. Literally, when you get out of a trade that you think is not working, just because you didn't have the patience enough, you haven't yet reached your exit point. Your strategy has told us nothing about exiting. Suppose, in this case, of course, it did tell us to exit. That is when the market will make a huge move in the opposite direction. And if you are paying attention, that's when you should say, "You know what? I should have gone long here again."
Hey,
Even
Himanshu,
though I went short and lost money, I went long and lost money, I went short and lost money, I went long and lost money, I went short and lost money, you still should have gone long here, because that is your strategy. And if you cannot trust your own self, then why even bother? But yeah, you have to go through this. This is what is called, initiation by fire. These things will happen to you a lot, which is why I tell people, hey, you know what? Start with a weekly chart. Such things will happen very rarely on a weekly chart. See, even though it did happen here, if you short SPY at 381.97, it still went to a low of 373. Yeah, that's close to $18, but that's $18. But if you had an at the money put here, that put has already made you 10%. And you would be out the next week. And if you go long right here, literally 2 weeks later, you are out again with your 10%.
You might have answered this before, but would the 10%, did you say you could use other percentages if you wish to? Or would you stick with 10%?
I would stick with, I prefer to go with 2 contracts and a 10% get out of one and move my stop loss to break even.
Right.
After that, as it moves up, I'm moving my stop loss up. Or then you can say, "Oh, I already made 15%. Now your stop loss is at 10%. It moves up even more. You have made 20%. Now your stop loss is at 15%. So even if it suddenly goes down, you still made your 15% on the second
Sure.
contract.
I think Mark was going to say something.
Yeah, Himanshu, are you using stop loss orders on calendar spreads?
No. In calendars, I'm in a calendar is a long-term trade, so I am adjusting as I move around
Okay,
and continue to do so. But then again, there are times when I'll have a very short-term calendar where my short leg is literally like 10, 11 days, and my long leg is 14, 15 days out. In that case, yep. So obviously, I'm not looking at a weekly chart over there, because then, there's no point. But over here, let's say I may literally place a trade. It's at 401, the previous high is at 407. So maybe I'll just place a calendar at 410. And as the price moves to my direction in the next 1, 2, 3 days, price has reached 411. My calendar has already made me my 10%. And then the next day it comes down. So my Vega helps me even more. Now I have made about 11, 12%. Then it goes back up to 410 or 409.067. So if it stays at 410, I'm making money, right? So maybe I'll hang on to it for, a day more or 2 more. But again, this is a short-term trade. In my long-term trades, it's like I put on a trade and then I'm out golfing. I literally get into my car and drive for, go visit my friend in Delaware or Massachusetts or in Ohio. Yes, in summer, not in when it's freezing outside. I don't venture out. I'm a warm-blooded animal, put it mildly.
I think you mentioned, Himanshu, that you could use this to trade futures or currencies as well. This approach that
Correct.
you're taking.
Oh, yes.
Would you have to categorize the market before adopting a particular trading in a particular market? Would the market have to have certain characteristics?
Well, one, actually, it needs to be trending.
Okay.
For example, if you look at AT&T, right? Now you can see that AT&T is literally moving around a lot. But literally 10 years ago, AT&T was a stock that would literally just stay there. And if it made like a $1 move in one day, people would like freak out. Not one day, in a week, people would freak out. But today things are significantly different. You will see that, well, even GLD, but see, sometimes GLD does this, see, or a few days
Yeah.
is ranging like this. But that is why I'm saying, see, when things are ranging, having an at the money calendar or being delta neutral is perfectly fine. But as you can literally see, it is very, very difficult to see the market. This is 3 weeks of gold, 3 years of gold. See, literally gold has moved from 160 to 174 over a span of 1, 2, 3, 4, 5, 6, 7 weeks, okay, which is not too bad. But if I go to a daily chart, and if we go to see, this is GLD, and GLD literally went from 138 to 194 because everybody was in panic mode, right? This is the coronavirus.
Well,
And everybody was panicking. And when people panic, they buy gold. So there are, but usually prior to this thing, if you look carefully, you won't see, look, see, GLD doesn't move much.
so would you try to wait for it to start moving before you would get into it with this kind of trade?
Correct. Yes. I
Nice.
want something that is not static. I want something that moves around a lot. That's where the direction comes into play. And it's much easier also. It's also easier to make 10% on a directional play, a directional calendar in like 2 or 3 days, as opposed to in a delta neutral trade when the market is essentially doing nothing. That's where it may take you a week or 2 or 3 for theta to kick in.
Okay, who else has some questions? Please feel free to turn on your mic or
Hey,
type them in.
Himanshu, I got a quick question for you.
Sure.
What do you do with the T+0 line kind of like sags, right? So like there's a big move in the market and the T+0 line goes against you, implied volatility goes against you. Do you wait it out or do you get out of the trade?
Usually I will wait it out. But again, that's me. If it's a long-term trade, then it is advisable to wait it out because you still have time on your side. But usually also what happens is that sometimes when you have a double calendar and there is a huge sag in the middle, that's because you place your calendars too far apart. So it could very well be your fault as well and nothing to do with what the market is doing. The other thing that will happen is that sometimes we don't see where the VIX is and we place a trade. If the VIX is literally, let's say the VIX is at 25 and you place a trade in SPY and suddenly SPY goes up by $6 as it did today, you will see a sag because now your positive vega, remember all the vegas are positive in a calendar. Your positive vega is hurting you. So you have to be careful about that as well. Did it make sense?
Yes, absolutely.
Okay. Dorian, why are you so quiet?
Go ahead to ask the questions, Charlie. Or make some comments. Or anyone else. So when is your book coming out, Himanshu?
2 of them are already out.
Oh, okay. I saw those. You're
One is on price action. The other one is on support and resistance. And essentially, those 2 books combined is about all you really need to know very well to make money in the stock market or any market for that matter.
These are the ones that have been out for a while, right?
These 2 have been out for a while, yes. And then there were a couple of minor health hiccups in my life. So I was busy with other things. And when I really started getting into my books again, some other people in my family had some different kind of health hiccups. So essentially, as you get old, all these things start happening.
Sure. So no, that's great. There are co-authors on those books, right? On those earlier books, but they still represent your own view. Is that correct?
Well, the other 2 guys are my students.
Oh, I see.
And they were like, well, in fact, one of them, the female one, it just happens to be my cousin also. And she's about to retire and she wants to trade Forex. And I'm like, okay, so I'll teach you how to do that using technical analysis. And she makes copious notes when I'm talking. So she actually, typed it all up in a Word doc and sent it to me and to ask me whether what I said and what she wrote was correct. And I looked at it and I said, not only is this correct, but we can sell this thing on Amazon. And she's like, yeah, let's do this. So that's how it all began.
Oh, see, that really changes my. I'm definitely going to. They're quite inexpensive, right? They're virtually free.
Yeah, $3.
So everybody who wants. Well, I'm certainly going to buy them both and check those out. So really,
well, just John has a question. Just type in my full name, and only two things will show up. That is my full name.
Yeah,
So Himanshu,
Anytime-
where's the next move on the SPY moving forward here?
The next move on the SPY is down. But again, are you talking about tomorrow?
Yeah,
Or are you talking about over the next 30, 40, 50 days?
well, maybe in my view tomorrow or over the next few days.
But tomorrow it'll probably go down a little bit.
I mean, I would have thought it would have gone down 4 days ago.
And did you go short?
No.
Oh, okay. But I bet you a lot of people did go short 3, 4 days ago, which is why it went up. You know, these cycles continue. Like there are some people who are like, every time I buy, the bloody thing goes down. So I literally tell them, then you are your own trading system. Every time you really feel like buying something, don't buy it, sell it short. So it'll go in your direction then. But again, I'm literally, to be very honest, like, right now, if you have to trade the spider, you just say, I'm going to wait. I'm going to wait until it comes back to this blue line. If it closes below the blue line, I'm going to short it. If it bounces off the blue line, I'm going to go long. That would be the next thing that you would do if you are trading SPY or the other one, IWM, same thing. See, IWM is like not really moving up and down too much. It is ranging. But this one also is too far away from the moving average. Same thing with the Qs. This is way too far away. But this is where, now look what is happening on the RSI. RSI is like literally almost close to 80. Therefore, RSI is just about to go down. Which means prices will probably come down too. Again, this is, to be very honest, this is a pretty unsustainable move, right? From 285 to close to 380, 372. That's like 100 points in 425 to 615. So 425 to 515, 525, and another 20 days, minus 8 plus 4, 12 days for holidays and all, weekends and holidays. But what will happen also is that right before the 4th of July weekend, you will see the market go up a little bit. And then right after the 4th of July weekend, it'll come cratering down. Sure, John. Thanks for being here.
what will be in the new books that's different from the old books?
Old books.
Well, the current books sound great. I'm going to buy them right away. Your books on Amazon. What will be in the new books that you're currently?
Oh, in the new books are some technical strategies which deal with some of these indicators, the way I use them. I never use RSI 14 at 70 and 30. I use it in a slightly different way that really works very well. Like really, really works very well.
Great. Well, I think we can all afford to buy all of them. And I suggest people do exactly that, buy the books, and we'll have a meeting at some point.
Yes, I would be very happy and grateful to you for doing that. And if you have any questions on the books, yes, we can meet like this and you can ask me as many questions as you
I
want.
was going to say it wouldn't bother you, but that's even better. If, but in any case, people buy the books. And because the reason I'm saying it right here is because otherwise people may never hear, think of it again. They may not see. So, but we'll schedule a meeting down the road. We got Mark too. who can help, and Himanshu is absolutely welcome to take his valuable time if he wants. And let's plan that. Fantastic. Mark said he can show some of his stuff, Himanshu, that it would be based on yours. Is there anything? We don't necessarily keep you all night unless you want, So
I have, as I said earlier, I have nothing to do.
Well,
Literally, I have
One last
nothing to do.
question for you. If you were to pick what 3 to 5 instruments would you pick for somebody who might be new to this to focus on?
I would definitely look at moving averages. One of my entire trading life began with, okay, let me see, where is he? Let me show you this one. This is what I use more than anything else, or have used, I should say, more than anything else, as far as indicators go.
what does that say? I can't read it. I'm
It
sorry.
says Woody's CCI.
Woody's
CCI, yeah, so CCI was an indicator that a gentleman by the name of Don Lambert came out with in the late 80s. That is when Ken Woods was actually a trader in the New York Stock Exchange. And then when the when they went all electronic, Woody sat down with Don and said, can we make some changes to this indicator, or how does this work? And together they came up with essentially the same indicator, but instead of just a line, it comes out as a histogram, so it is much easier to see. But it also incorporates a lot of other things. This is yellow, then red, then green up here. And over here it is light blue in color. Here it is more or less light blue most of the times. Here it is green, red, yellow. So all of these things together literally comprise of a full-blown trading system. And it's a pretty great trading system too. So
Wow.
I use this a lot.
Is that what you meant? The person who asked the question?
This is great. I was actually asking about the instruments. So like whether it's Tesla or SPY or QQQ, like which ones follow technical analysis, at least your style of technical analysis really well, that would be easy to profit.
Let us assume that there are about 100,000 instruments, right? Then I would say 99,990 of them would follow. You would make money following my system. There are one or two that are weird now, and all those reverse ones. Remember those inverse ETFs?
Yeah.
Like when the Qs go up, that thing goes down. But when the Qs are going down, that thing goes up. If you try to use indicators on those, because they are like 2x and 3x kind of things, you will sort of get screwed up. So if you want to trade those, you still need to look at the Qs themselves. And you can say, okay, the Qs are giving me a bullish signal, so I can short that other guy because it is going to go down twice as fast. Did that make sense?
Sure. So you'd say the Qs, SPX, RUT.
No, other than that, anything. You can literally look at the entire S&P 500 and it will work, or the NASDAQ 100. This entire 100 shares or companies will work great with technical analysis, especially because it is the NASDAQ, and by default, NASDAQ moves a whole lot faster than the other ones, which is our SPX. The Russell 1000, 2000 also move very well, but a lot of them don't even have options. So if you really just want to go with just plain old stocks, like for example, this Ashland Inc. I have no idea what this thing is, but it gave you a signal to go long here at 102.49 and it reached a high of 104.78 in less than 3 days. You made $2. On the other hand, you can go with something like app, whatever that is, Eplovin Corp. Okay. See, some of these I've never even heard of. Like literally, I have never heard of Eplovin.
So you don't have any minimums for like volume or anything like that that you'd filter out?
Well, yes, normally, yes. I mean, over here, well, this guy has significant volume, but yeah, if it's less than 200,000 shares per day, I would tend to avoid it because then what happens is that the bid ask spread on options is very high.
Yeah.
Actually, even here, the bid ask, see, it is 360 and 390, it's 30 cents. So I don't know, is this a new company? Because I don't remember ever even hearing about this company before. But then again, you know, I try to keep myself, again, this is the Russell 1000. Why would I trade the Russell 1000 when we have the NASDAQ 100? And 100 underlyings is more than enough. I would suggest you start with 2 or 3. Like pick 2 or 3 really good underlyings that you like, whatever they are, doesn't matter. Like for example, let's say you Apple, Adobe, Amazon, Costco, Google, McDonald's, Meta, Microsoft, Netflix, Nike, Nvidia, PayPal, Starbucks, Shopify, and Tesla. These things, these many will keep you busy for, well, it'll keep you busy until one of 2 things happen. The first thing, which is the thing that we want to happen, is if your small account suddenly turns into a large account because you are following the rules and making a lot of money. The other thing is that'll happen is the opposite, where suddenly you'll be like, okay, I now have, like, you know, I started with 30K and now I have only 3K left.
What should a person do when that happens to them?
Well, if that happens, then usually it means that that person did not have a plan, or they had a plan that they did not follow. You know, I mean, if the plan is that if it closes here, I'm out, right? And if you don't close here, hell, in this case, it worked out very well. But look, over here, your plan is that if it comes to 34.03 or say $34, I'm out. But you decided to stay there and you had 1,000 shares. And it goes from 34 to $9.14.
Yeah.
And you might still say, you know what, maybe this is a great company, it'll come back. And guess what? It did come all the way back to 25. But Natalie is telling me something. Oh, sorry. What was I saying? So the point is that if you did not follow your rules, and if you had 1,000 shares, you just lost 25 grand. Now, if you have a $1 million portfolio, that's nothing. You can say, hey, I can handle this. But even with a $1 million portfolio, if you continue to do this, eventually you are going to be on the streets.
So
I
this
have told you more
psychological
about that.
problem is
It
affects
is
a large number.
always it is always psychological problems. It has got nothing to do with the market and even your ability to read the market. We have put there, as I said before, it has statistically been proven that heads you buy, tails you get out. If you follow that system, you will still make money in the long run.
That's great advice. Any more questions? And then Mark is going to show his interpretation of some of the similar concepts. And you're welcome to stick around or leave as you wish, Himanshu, if you're pressed for time.
Oh, no, as I said, I have nothing to do. I might just go and get myself a cup of coffee.
Yeah, okay. Well, then, Mark, why don't you go ahead and share?
Okay, I'm gonna take over here. I'm not trying to hijack the meeting, but Himanshu is a big inspiration of mine. And but we all, I've been trading for 15 years myself. So, I've developed my own ideas about things. Let me see, I'm trying to share. Okay, says you cannot start screen share while the other participant is sharing. So
Let me see if we can fix that. Let me just see.
Hold on, before I left, I heard, so I have to stop share. So I'm going to stop my share here and then hopefully you will be able to.
There we go. Okay, let me try.
Okay, I'll be back in 5.
Okay. Here we go. I think everybody can see my screen here.
Yeah, we can see it. Thank you.
Okay. So I've got my own ideas, and it's not too different than what Himanshu's doing. So on my charts tab, I've been influenced by the shadow trader group that used to be on Thinkorswim, and they are no longer on Thinkorswim, but they used to be here under the chat group. And anyway, they're no longer there, but they do a lot with market breadth analysis. So many of these indicators we watch are moving averages of price. And so you're essentially looking at price, looking at what price did in the past to try to determine where it's going in the future. Well, sometimes that works and sometimes it doesn't, because it doesn't always follow, in a trend following, you would think it would just keep going in that direction, but we have these periods where it doesn't. And so I felt that indicators based on trend following or price following had a problem. And so anyway, you can see here in the upper left, actually, I watched the $ADD, which is the New York Stock Exchange advancing issues minus declining issues. And so I watch that every day, and I've got it on a 5-minute chart here. And I have this is the shadow trader way. I just renamed it with my name in it here. But you can buy this from shadowtrader.com, the weighted advanced decline. And I've got the same study in a little longer time frame down here. And let me just pull this up. I'm going to maximize this screen for a minute. Okay, what we're seeing here, it's a comparison. Okay, so there are certain sectors in the S&P that carry more weight than other sectors, and that's what this indicator is built around. And so the white line is essentially a advanced decline of the S&P on an unweighted basis. And the bars themselves are the S&P on a weighted basis. And so if I click on study, so you can buy this indicator, like I said, but if I click on studies here, and you can go to, where is it? Right here. No, cumulative tick. Here we go. Weighted average shadow trader. So these are the different weights. This is the XLP, the XLU. So these are all the different sectors. And the big one is the XLK, which is technology, I believe, at 27.9% currently. So when I look at it this way, it tells a story day by day. And I'm going to minimize this again so that we can see this in relation. So this is a 30-minute chart on top. Just ignore these red and green lines for the moment and look at the candle. So this is over the last roughly week. And you can see how I've got the crosshairs synchronized from the lower chart to the upper chart. So it kind of tells a story each day. So, you know, this day we had the S&P up on strength, and the way I'm reading that is the weighted stocks, which are the more important read, were stronger than the unweighted reading. So we were up on strength. The next day was more of a balancing day with kind of a little chop above and below. The next day after that, it was chop in the morning, and then we had another period of up on strength. And so, you know, you never know what's going to happen to the right of the chart as time moves forward. But you know, when I saw this, I thought there's a lot of strength in this market. Let's get out in front of it with something to catch some profit on this upside move that's coming. And so the way I like to play this, there's actually an implied volatility pricing anomaly. If you start looking at the Friday, Monday pairings, you'll see usually the Friday has a little implied volatility advantage over the following Monday. And so I'm doing these just pretty much on a weekly basis and picking I'll sell the Friday and buy the following Monday. And what that does, okay, I put this trade on yesterday. This has a huge risk reward. I mean, a very favorable risk reward ratio. So the downside here for a 20 lot trade, I paid 2,600, but my potential to make many times that 2,600 is there, especially if I am right on my direction here. So I just put this on yesterday, and I'm nearly at you know, probably 85% return already in one day on my $2,700 investment. I'm up 2,100 in one day. And so, you know, that's a very attractive return. You know, really, you know, conservative trading, you might just say, hey, that's a very nice return, let's take it off. But if you know, and I may take it off in the morning, and I will explain my thought process there in just a minute. But if the market was to continue up here for a few days and then a few more days elapse, you can see you could very easily get to several 100% return. So, you know, this is not something you want to do with your whole portfolio. This is kind of fun money. You know, if I can turn 2,600 into 10,000, I'm a happy guy. So that's kind of my directional strategy. So I'm using these Friday, Monday calendars. I'm usually, if I'm above the money, I'm usually doing it in the calls. If I'm below the money, I'm usually doing it in the puts. I may take Himanshu's idea and try some above the money put calendars, because they can be cheaper. You know, let's just model this out here. So to sell that trade right now, you get $2.45. To to buy at $2.45. What if we did it in the puts $1.80? So let me turn off my trade and model this out. So but normally I would do this in the calls and it would cost me $2.45. So that's your max risk. And on a 20 lot, let's adjust that to a 10 so the math is simpler. So you could do a 10 lot for $2,400, you know, but if you did it in the puts, you could do it for $1,800 rather than $2,400. And so if the shit really hits the fan and everything screws up on your trade, the max you lose is your debit, theoretically anyway. But anyway, so this is how I'm doing these directional calendars. So the way I'm going to play this tomorrow, we'll see how the market opens in the morning. So every morning when the market opens, you know, at 9:33 or something like that, we'll begin to see how the advanced decline is playing out. And you know, it can be positive or negative. If it's plus 1,000, I read that as a bullish reading. Plus 1,500 is even more bullish. You know, same thing to the downside. If it's minus 1,000, that's bearish. You know, but oftentimes it could be somewhat neutral and then progress to the upside. So it's not totally the absolute value of what we're seeing on the advanced decline, but which way is it going? And so I try to wait till at least 10:30 before I make any decisions about my holdings, because we can open neutral and then just rocket to the upside, in which case I'd rather stay in this trade. If we open negative 500 on the advanced decline, I'm going to be very cautious about this and maybe go on and close it. I'd love to capture that $2,200 that I'm up right now. And if we have a bearish day tomorrow, I will definitely go on and close this. But, you know, if the momentum is up, if I'm seeing, again, on this weighted advanced decline, it takes, you know, the first 30 minutes of the day at least to begin to form a trend as to how the day is going to play out. But you can see today it was just straight up from the open. And I was glad that yesterday afternoon, so what made me think is yesterday's price action, we had this big red candle at about 2 o'clock. And what happened? It totally traded out. There was no continuance to the downside. And so I said, you know what? This market, there's nothing standing in front of it right now. And so I got out here and let me see, I put on this spread at, what was my strike? 44.75. So also, as you position these things farther out of the money, let's talk about positioning just a minute here. I mean, you could have looked at the chart and said, oh, you know, I mean, my thought pattern may have been correct, but you could have said, well, I don't think we're going to get beyond about 4,400 or 4,425. But look at the different pricing as you manipulate your strikes here. 44.20, well, it would have been different when price was down here yesterday, but so let's just put it up a bit. The 44.50 is 285, but if I move that to 44.75, it's 245. It drops significantly as you manipulate this price up. You may even want to put it at 4,500. That's about what I paid for this spread yesterday, is $1.90. I like to get these things for less than $2 because the risk reward is just much more favorable than if you're paying $3.25. I mean, on a percentage difference, say $3.50 to $1.90, that is a huge pricing difference, and that's really money in your pocket, and it's accentuating this already fairly nice risk reward relationship we have.
So basically, I think it's consistent with Himanshu's approach, which is simply have a directional bias. Now you can base that off indicators, and in your case, you're just using a particular indicator that you like.
Yeah, exactly. Yeah, I mean, there's a bunch of them out there. I think, you can spend a lot of time fooling with different ones. At one time I had 6 different indicators on here, and it's like Himanshu says, the 3 of them are saying up, 2 of them are saying neutral, and 1 saying down. And, what do you do with that? Another indicator I'm playing with here, this red and green line is the McClellan oscillator summation index. So that's one of the standard studies in Thinkorswim. I have recoded it to make it red and green to help me spot the direction changes. But the way I read this, okay, on the 5-minute chart, the McClellan summation index, usually when it changes direction, it indicates a change in price. And so, the market tends to go through waves of buying and selling that play out over anywhere from 3 days to a day and a half, if you zoom in from this sort of perspective. And so, right here, when we went from red to green this morning, that actually was a decent signal. Right here was not such a great bearish signal. Right here would have been a great bullish signal when it changed at this point. So anyway, there's a lot of different indicators. I think you pick one.
Let's ask Himanshu, if this is consistent with the kind of way he would trade it.
Oh, yes, definitely. I actually trade these short-term calendars a lot, and it is much more fun too.
Well,
So
they play out very quickly. I did a lot with direction neutral and my 60, 90-day calendar, and those are such slow moving creatures that you can lose patience. And these things, for a small amount of money, you can make a decent amount of money quickly, and it all plays out by the end of the week or the end of next week.
Yeah, so Mark, you're basically trading what, like a few days out, or maybe a week and a half out? Is that right?
Yeah, anywhere from about 9 days to 3 days. And really what I'm looking for, it's a little bit of a seat of the pants thing here, but I like to see a definite change in direction. And I saw that yesterday afternoon when we had, on the 30-minute chart, we had this solid bar that finished near the low, and you would think, hey, that's really bearish. But what did the next bar do? It totally traded out, just about. And so this to me was a bullish pattern. So I like to look for changes in tone across these different indicators, and if I can be assured that we're making a turn in either the up direction or the down direction, I like to get out in front of it and take advantage of that move, because look what a big range of safety I've got in this thing. This is, you can sleep well at night knowing you've only got 2,600 at risk. You don't have to hedge. You don't have to do any of this fancy stuff. You just hope that your analysis of the direction is right. And like I said, if we open up tomorrow with strong readings on the advanced decline, I'm going to let this thing roll, and maybe I do make $10,000 on 2,600.
That'd be great. And Mark, you've been trading this style for what, 1.5, 2 years now? These short-term calendars?
Yeah, I did the longer term stuff, but when they went to everyday options expiration, the market changed, and we've seen this jerky up and down. Like Himanshu says, the delta neutral trade is just dead in this market. You cannot stay on top of it. They move too slow to make any money that way, and so you know, what I like about this too is I can trade with a very small percentage of my account and use the rest of it for other things. And it's a trade that's got a lot of bang for the buck, and it plays out very quickly. So yeah, you know, and one way I figured out about this is, you know, put them on, you can put these things on right at the money and notice the price. I mean, I touched on this a minute ago. The pricing is significantly more if I was to put this on at, say, 44.25. It's $3.10, but you know, out here at 45.75, 245, you know, even 4,500 is not too far away, you know. And what does that look like on this? Well, you know, we're way down here, any up move in price, and we're making money. You know, we're obviously close to the downside, but if our analysis was right, it can really pay off. So, like I said, I like to get these things for less than $2 if I can, and I've done pretty well with these. So,
Do you ever mess with diagonals? Or do you think it's calendars?
I have played with diagonals. I like the calendars because you can do them for a lot less money. The diagonals have additional margin requirement, and so you know, I've done different things with diagonals. I like them, but really the most conservative way, you know, as traders, we got to watch how much we're investing in these trades. I mean, I've done trades where I had $100,000 in one trade, and I'm like, that's great, but man, if you know, if the black swan
Things go
hits,
south.
yeah, that could be ugly. And so, you know, if the shit hits the fan and I lose $1,800, well, you know, I've done worse. And so, I like that I don't have a whole lot at risk. You know, I don't have to fool around with different hedging approaches, which get awfully complicated. And, you know, if I can make over 100% return on a small amount of money in a week, I'm a happy guy.
Mark, do you usually put these trades on always on Fridays?
No, I you know, I look for cues in my indicators of a turn in the market, and I'll do them anywhere from 9 days out to about 3 days out. And I've done, you know, if you get the move in the market, you know, your prediction winds up being correct, which is, it's not an exact science, but the more you work with your indicators, you know, you can get pretty good. I also use the Shadow Trader cumulative tick study, which is also one of their paid studies, and you could get these at, I think it's shadowtrader.net, I believe.
Yeah. Mm-hmm.
But anyway, they've got some good stuff. They used to have a great show on Thinkorswim, but they got rid of those guys. But they did a lot with market breadth studies. So the market breadth is all loosely based on advancing issues divided by declining issues. And so the McClellan oscillator is calculated off of that. So it's advancing minus declining. It's not a derivative of price. It's not a moving average of price. And so theoretically, you know, and it doesn't always work right, but I've also got the McClellan oscillator. It's the summation index on the 30-minute chart. And, you know, this down cycle didn't pay off very well, but the up cycle did. And so, yeah, I look at a number of things, but this is somewhat I'm looking at. And if you set up with these directional, these Monday, Friday calendars, there's a whole lot of bang for the buck.
Hey, Mark, if you get a move up in your favor, are you going to add another calendar above? Do you do that as long as you have enough time?
I might, depending on the pricing. Like I said, I like to pay less than $2 on these things, but it's also, you know, we're triangulating time to expiration too. So I've already taken off my trades for this week, this Friday. I'm usually closing these things out on Wednesday or Thursday. But I have put them on as late as Wednesday for the Friday, 3 days away. So, you know, the more you play with this, you'll get a feel for it. You know, I've tried to come up with like a rule book that I can give to friends or people that are interested, or mentoring students, and there's just a certain amount of experience that you can only get from playing with this. But to answer your question, I might just take profits. It depends what the market is doing. Say if we were to get up to 4,500 and there's still another 5 days to go, I would probably just close it out and move on out to the next week. You know, with, you know, say by Monday afternoon, Monday or Tuesday, we're already at 4,500 and I'm up $6,500 on a $2,600 investment. I would go in and close it and just pocket that money before something bad happens. Trying to adjust these things often runs into more and more money, because say if we were at 4,500 and I wanted to put on another one to double this up at say 4,550, well, those are going to be starting to be getting expensive later in the cycle.
Yeah, like $3.50.
Yeah.
Yeah.
I really try to keep it simple and not do a bunch of adjusting. If I can just put one on and you know, hit the jackpot with it and just take it off, I think you're better off than putting more and more money behind the trade, trying to make, you know, a bigger sum. So
I've noticed lately that the 3-day spreads are getting some backwardation, where if you go to different spreads, like a 5 or a 7, you don't get that backwardation. I think the backwardation has a lot to do with what you're doing here.
Well, you know, I've played with different spreads between the front and back, and you can see.
Right now, you've got 11.79 against 10.91, and you probably pretty much started that way too.
Right. It probably hadn't changed much, but see if you, so this is the Friday, Monday, but if I was to do the Friday and then by the Wednesday, notice how the wings are dropping down. If I moved, you know, theoretically a calendar makes money on the difference in time decay between the front and the back. So you would think moving the back farther out in time, they would work better. But what happens is you're piping more and more risk into that trade. And you know, I think they work also based on appreciation in the long leg too. So so I stick to the Friday, Monday pairs because I just like it. I like the way the graphs look. It gives me a really wide range of safety. If I can get up here to the middle of the profit tent, you know, the T+0 line is still very flat here with, you know, just how many days to go till next Friday. I guess we're at about 6 days to go here. So
but the point that Lindsay is making is that the backward, he's saying, like, if the volatility, implied volatility of the short leg jumps up, then you'd be in trouble. Is that right? Or
well, it would be trouble to begin with, but it doesn't always stay that way.
So you got to hold through a little bit of a loss in value of your trade.
Well, you know, that's usually not going to happen unless the market's rolling down. Now that could happen. Say if I think we're going up and the market actually goes down, then yes. And I've closed these things for a loss if I turn out to be wrong on my prediction of direction and we're moving down this way. You're right, that change in implied volatility is going to tend to depress the line right in this area. And so, yes, you can lose money. But when you get it right, it's really nice. And if I was to position the calendar to the downside, that change in volatility benefits you rather than hurts you because the market is coming towards your spread. you always want the market moving towards your spread. You don't want it moving away. And that's why I've kind of gotten away from doubling these things up. I used to do one below and one above and think, okay, that's great. Well, if the market just grinds up, that lower spread kills you. And
Yeah,
so
they're working against each other.
yeah,
You know.
they're working against each other. And so really you make the most money if the market's moving towards your spread. And it's a little bit of a gray art as far as reading these indicators and figuring out which way you think it's going to go. I mean, I would have thought several days ago that we were about at a top. I like to look at a daily chart too. After we came up here and we put in this red bar here, I was thinking, that's not looking good. But what was my weighted indicator doing on that day? It was chopping around neutral actually after a move up. So that day kind of gave me pause. But then the next day was so bullish, I just felt like nothing was standing in the way of this market. And so I got out in front and I did nicely this week, and I'm already up 2,200 for next week.
One last question, then I'll let you go. When you start these, your T+0 is really not flat too much.
No.
If you move up into your area,
Yeah,
it's already got a curve there, right?
it does. Let's set one up that if I was still very bullish, I would probably go with something like this for 190 in the calls. See if it looks any better. It's only $1.25 in the puts. I don't know if there's any downside to doing this in the puts. Himanshu doesn't seem to think there is a downside. I would normally do it in the calls though. But you're right, the T+0 line is not very flat. This is not a delta neutral trade. It's great to have a flat T+0 line, but again, that is a concept from delta neutral trading. And
yeah, right now it's not staying there.
Yeah, and I've gotten away from the delta neutral. Originally, I wanted to craft my strategies so that I could have, that I could park a huge sum of money, possibly run a hedge fund and have like 100,000, a million, whatever the number is, have a substantial sum of money sitting there and be able to make money on it that way. And I've kind of gotten away from that notion because it's too much at risk. You got to have some very complicated hedging things going on, or it's just not responsible. And this way I can put on these. This is a relatively small amount of money here. In the trading world, if you can, and you could trade smaller, of course. Maybe $1,800 is a big sum to you. You could do a 5 lot for $947 right now. And if you get the direction right, it's great. Now, yes, you can lose money, but you can make more than you can lose also. Here's an example where for $946, if it goes up here, I'm seeing it at expiration, you're never going to make that number, but you could easily make several $1,000s.
No, let's answer. Well, I got one question for you. Most people are not really at the level of dealing with the subtleties of fine adjustments because they're still fighting the psychology. As Himanshu mentioned, most people, their problem trading is just that they won't get out, they won't take their losses, they won't take their profits. Do you find yourself, now that you're an advanced trader, you're a sophisticated trader, do you still find yourself challenged or threatened by the psychological aspects of this, or have you overcome that?
Well, it's always a mind game. You're never sure if you've quite gotten it right. I don't always get it right for sure. And so, yes, there's a lot of second guessing yourself. you know, and that's why I've kind of crafted this strategy that has a very nice risk reward. If I lost $900, well, I wouldn't be happy about that, but it wouldn't change my lifestyle.
So you're
and
being fairly conservative.
So I'm being conservative. I'm conscious of the risk reward. I'm very conscious of what I'm paying for these spreads. You know, in this case here, $1.90 versus doing it in the puts for $1.25. I mean, that's even better. So I may try some of these in the puts deep in the money and see how that goes. But
Hey, Mark,
yeah.
this is Himanshu. You should try one other thing with these calendars. Try to put them on, have them ready, and click on confirm and send exactly at 9:30 a.m. What you will find that even though you are offering $1.50 or $1.25, you might get filled at 90 cents. This happened to me before a lot of times.
Okay.
Do you have to direct the trades, Himanshu,
Do I have to direct?
to particular exchanges?
No, I don't do that at all. I just say go and I'm done.
Which is basically 9:20. What is the significance of 9:20?
No, not 9:20, 9:30.
9:30, I'm sorry, just
20
as the
20
market.
seconds after 9:30, you hit send, because that is the time when from the previous day's snafu that some traders may have been into. Because remember, 8 out of 10 traders are wrong on directions. So the guys who were wrong yesterday evening at 3:45 p.m. are now busy trying to get out. And that is where your spread will actually get filled at a mind-boggling price.
Do you think you
Like
get
my
better
rule for
fills?
this trade, my rule
Uh-huh.
for this trade is that if it is more than $2.50, don't enter. Period. It's like 250 is my maximum that I'm willing to pay for this. But 250 can easily go to like $4 in like 5 days.
So you're effectively making a market here for other traders. And
Well,
making,
yeah, I mean, if somebody wants to get out desperately and are willing to
sure,
do whatever it takes, but if it's helping me, I'm helping them, right? By
absolutely.
giving
Do you put in the price in at 90 cents or do you put it in at like $1.25 and then you just often will get filled at like 90?
That has happened, but sometimes what happens is usually at exactly when the market opens up, none of the prices are actually fixed at that point in time. The calculations are still going on in the back, and you will see a lot of these fluctuations happening. And in those fluctuations, because everything is automated now, you might just get filled. In fact, you will get filled a whole lot more often than not, especially if you do this on a Monday morning.
Sure. I mean, Interactive Brokers claims it is called price improvement, right?
Yes,
And
which is- for us, yes.
certain brokers claim that they give a lot better price improvement than others. But I suppose if you're right on the open, then maybe it doesn't make much difference.
Yeah,
Okay,
it
so
doesn't make
it's
much
not that you
difference.
put it in the price, you don't put it in the trade at 90. You just put it in at $1 or something and you get the price improvement.
Right. No, but normally, even at that point in time, it is never like $2, $3.
Right.
Because later on, literally, if you place the same trade at like 2:30 p.m. in the afternoon, it's like $4.25. Same damn trade. And the price is also at the same damn place. So obviously, it has nothing to do with the price at all. It was just the time. That's the only thing that was different.
Yeah, that's great. That's great. We shouldn't keep people all night or longer than we should. So are there any other major themes or questions? Oh, hang on. Chris says IB even fills outside market hours if you specify when placing the order. No, it's true. Have you tried any that? Himanshu?
I have not used IB in a long time. So I would not know.
Yeah,
I've never seen it happen in TOS.
yeah, they may not submit them. They may not allow
That's
fills
very
out.
possible. Yeah, that's possible.
So are there any important themes that anyone wants? Because other than that, we should let everybody go. After a fantastic meeting with TOS, yeah, TOS does not allow that, Lindsay says. And yeah, thank you, Ron, expressed it well. Thank you, Himanshu,
You're very
Mark.
welcome, Ron.
Thank you to everybody, and especially Himanshu, and we want everyone to buy his books, and let's come back at this after everybody gets a chance to read his books. Thank you so much.
Sounds good. Thank you all.
Thank
Thanks,
you.
Himanshu.
Thanks, Mark, for a good treatise on short-term calendars.
Yeah, that was good. That was good.
I'll see you guys later.
All right. See you.